A $7.5 billion acquisition, funded by a balance sheet that currently holds just $5.1 billion in cash. That leaves a massive, $2 billion crater of new debt, slated to hit the tape in the second half of this year. And Wall Street consensus is completely ignoring the impending interest drag. This is the reality of the tape. We track and verify the public forecasts, the exact narratives institutions want you to trade on. Before we dive into the forensic data, let us establish the target. Texas Instruments is the foundational backbone of the semiconductor sector, engineering the analog and embedded chips that operate everything from heavy industrial machinery to modern automotive systems. Because their components are ubiquitous, their data acts as a direct pulse on global industrial health. We pulled the transcript from their latest earnings call. Chief Executive Officer, Javi Villan, described the previous state of the industrial sector as a state of hibernation. Crucially, he explicitly denied that the current demand recovery is being artificially propped up by customers double ordering. We crossed this claim against their 8K filing, and the internal math aligns perfectly. Days of inventory outstanding plunged from 222 days, down to 209 days, moving alongside an absolute inventory reduction of $109 million. This eliminates the tail risk of a supply chain false dawn. The order inflows Texas Instruments is experiencing are driven by real, end-market consumption. A true macroeconomic cyclical bottom is in. However, while the top-line recovery is verified, the bottom line harbors a deliberate, structural landmine. During the question and answer session, Chief Financial Officer, Rafael Lizardi, flatly refused to provide a generally accepted accounting principles gross margin bridge regarding their recent acquisition of Silicon Labs. This was not a casual oversight. It is textbook, strategic masking. On the surface, the gross margin for Texas Instruments defied gravity this quarter, expanding to 58%. But integrating Silicon Labs will inflict a severe, multi-point blow to near-term profitability. As I noted at the top of the briefing, the gap between the $7.5 billion all-cash price tag and their $5.1 billion cash reserve inevitably forces over $2 billion in new debt issuance in the second half of the year. The resulting interest expense will eat directly into earnings per share. Furthermore, the $17 million in mergers and acquisitions frictional costs already reported is merely the leading edge. The upcoming amortization of intangible assets from this merger will crush their gross margins over the next 12 to 18 months. Wall Street analysts are currently underestimating the financial pain of this early integration phase, while the Chief Financial Officer actively attempts to divert market attention toward long-term free cash flow to smooth over the immediate earnings volatility. That is exactly why you need FinWitness.com. We strip away the PR jargon to show you the verified metrics. Now, closing that file, and shifting our radar to the broader capital expenditure cycle. Despite the margin headwinds, there is a historic inflection point happening under the hood that supports a fundamental valuation re-rating. Management announced that their grueling, 6-year capital expenditure expansion cycle is nearing its end. They also dropped a highly specific phrase on the call, capacity modularity. That is the exact signal institutional hedge funds have been waiting for. Trailing 12-month capital expenditures currently stand at a massive $4.1 billion. But guidance for 2026 sharply drops that figure, to a range between $2 billion and $3 billion. This mathematical reality means that even if revenue growth flatlines at absolute zero, Texas Instruments will generate at least an additional $1.5 billion in free cash flow, out of thin air, in the back half of the year. Factor in the $555 million in direct cash subsidies they secured this quarter from the CHIPS Act, and their cash moat becomes unfathomably deep. If the macroeconomic recovery falls short of expectations, that modularity allows them to construct empty factory shells without purchasing the expensive equipment inside. It is prepared opportunism, providing extreme downward flexibility, and locking in a hard floor for free cash flow. Stitching the 8K data together with the transcript reveals a quiet, but aggressive, structural overhaul. The filings show that the ramp-up costs for their LFAB facility will be absorbed by the legacy analog division, yet the operational benefits will disproportionately flow to the embedded processing unit. Immediately after positioning this, they deployed that $7.5 billion to acquire Silicon Labs, a pure-play asset in Internet of Things, and embedded connectivity. The conclusion is absolute. Texas Instruments recognizes that the growth trajectory of legacy analog chips has flattened. They are leveraging their fortress balance sheet to forcibly buy into the growth engine of the next decade, industrial and automotive edge computing. Here is the forensic takeaway for your radar. In the short term, over the next 1 to 3 months, this strong revenue beat and the confirmed industrial cycle bottom will ignite short covering, giving the stock massive upward momentum. But extreme caution is warranted for the second half of 2026. When that new debt for the Silicon Labs acquisition hits the balance sheet, and the margin dilution masked by the chief financial officer materializes in the earnings, the equity could experience severe volatility. The true fundamental breakout, a simultaneous expansion of earnings per share and free cash flow, will not arrive until the first half of 2027, once the merger is fully digested and the capital expenditures have entirely rolled off. You cannot trade on press releases alone. By analyzing the latest earnings and SEC filings in real time every day, we ensure you are staying one step ahead of the market. To access the unredacted radar, visit FinWitness.com, upgrade to Pro today.